Welcome back everyone to our channel here at REI Tax University, where we talk all things tax planning for real estate investors. And as a quick refresher, this series we're diving deep into the world of depreciation, which is one of the most advantageous tax planning tools for a real estate investor, especially when understood and used effectively. In today's video, we're going to get into how to calculate and track fixed asset basis. Now, this is one area that I would say it's a very commonly misunderstood area, and it's one that can have very few investors understand and know about. Dire consequences if you don't know where you're at on it. Now, we love all our loyal followers of depreciation who want to watch along with us here, but I know this is not the Eras Tour and I'm not Taylor Swift. So if you want to throw your phone in your pocket, if you want to minimize the screen in the background and just throw your AirPods in and listen along, I'll be sure to grab your attention if we put something up on the screen that you need to follow along with. So what is fixed asset basis and why does it matter? Well, we talked about that when you purchase a fixed asset, you have to set that up on your balance sheet as an asset, and then you depreciate it each year using depreciation expense, which moves over to your profit and loss statement, and then having accumulated depreciation that reduces your asset on the balance sheet. So as we start talking about basis and fixed asset basis here, we need to talk about what accumulated depreciation is and make sure you understand. Accumulated depreciation is all the depreciation that you've taken on an asset over time. So if you take $12,700 in year one and you take $12,700 in year two, your accumulated depreciation is now $25,400. The good news is that's going to be tracked on your balance sheet. So you should know that at any point in time if you're actively tracking your depreciation expense. Now, assuming we put this asset, this building in service as of January 1st, 2024, and we're now at the end of 2025. So we're now at December 31st of 2025. And we want to know what is our fixed asset basis in this building. Well, what fixed asset basis is it's the total cost and purchase price that you put that asset on the balance sheet at to start. So the total cost and the total purchase of getting that in service, less the accumulated depreciation. So you started out and you put that fixed asset on your books with $100,000 for land and $350,000 for the building. Then each year you took $12,700 of depreciation expense. So your accumulated depreciation after 2 years is $25,000. If your fixed asset basis is the total asset purchase cost less the accumulated depreciation, then we've got $450,000 minus $25,000 that you've taken in depreciation. So your basis would be $425,000. Why does this matter? Most real estate investors really are focused on what the fair market value of their property is. How much is it worth if I sold it today? And that's great. That's what we want you to focus on first and foremost. The second number they usually know is what they purchased it for. The number they usually don't know is the basis number. And that matters more so than what they purchased it for. And here's why. If and when you go sell that property, you're going to need to determine your capital gain or potentially your capital loss. The way capital gains or loss is figured up is the net sale price that you sell the property for less your adjusted basis in the property. So frequently investors come to us and they're like, I'm going to sell this property. I paid $450 for it and I'm going to get $500,000 out of it. So I'm going to have gains of $50,000. I'm like, no, you're not, because you've already taken $25,000 of depreciation on this over 2 years. So that property is actually on your books at $425. Your capital gains aren't 50, they're 75K. So knowing this basis number can have huge consequences. If you know it, it may help you determine what that hit's gonna be if you decide not to 1031 the property and just sell it outright. It may help you determine if you want to use a partial 1031 and just offset part of the capital gains. It may help you determine if you want to use something we call a 1031 light or a lazy man 1031 that we'll talk about in a future video. So a lot of tax considerations that you'll want to think about here. It may just help you know what your capital gains tax hit's going to be when you sell that property if you're planning to just pay for that. Now in our example, we use selling the property in 2 years. Depreciation hadn't added up that much. But if you think about 10 years down the road, your basis is gonna get pretty low. Those capital gains are gonna get pretty high. So know your basis, folks, especially if you're planning to do an upcoming sale or any type of transfer or anything like that with one of your properties. As always, we appreciate you guys following along with us here. And I hope you got some real value that you're gonna be able to use and help put towards your own tax planning considerations as a real estate investor. We encourage you to like and subscribe and also to join us over in our community at reitaxu.com, where we talk all things about tax planning for real estate investors. Be sure to keep following along and catch our next video where we're going to get into bonus depreciation and really turn things up a notch on how you can strategically implement depreciation as a tax planning tool for your real estate investments.